John, it's great to have you in studio.
Great to be here with you, Joe.
So John, what mining stocks, gold mining stocks, are you looking at or have been trading recently?
I've been swimming with the sharks in there with the gold miners because that's been a nasty place to be, as you know. Since the last time we talked, gold fell another 150 points an ounce. That's a big drop. That affects, of course, the miners because their costs are probably somewhere around 900. So as you all of a sudden compress from 1,300 down to 1,100 to the ounce, that vaporizes a lot of profits, and of course, virtually none of these guys hedge anymore.
Right. So the one that's typically traded the biggest each day in terms of volume is Barrick Gold. Have you looked at them at all?
Yeah, that's been one of my most actives, in fact. I love to trade Barrick on big drops. I was selling puts actively in ABX. Knock on wood, you know, sometimes better to be good than smart or lucky than smart.
Yeah, right.
I was able to take a lot of money out of the puts because volatility shot way up, Joe, in all of the miners because of just that simple profitability equation we just talked about.
What have you been seeing with volatility index of these miners?
That's really interesting because GVZ, that's the CBOE's volatility index for gold in the miners. That pretty much reflects investor sentiment, just like the VIX does for the S&P 500. Well, the S&P 500 as of today is probably right around a 14 level for the VIX, but gold is around a 25, 24, 25. So in other words, they're saying that this supposed safe haven all of a sudden became so volatile that people were just running for the exits. And I think that's exactly what you and I were talking about at the end of the second quarter. We might see a whoosh to the downside. Well, we got that.
Indeed. And let's look at the ETFs. There's GDX, which is the gold miner ETF, and GDXJ. We'll get to that in a second. But what do you think of GDX right now?
I like GDX.
Oh,
and
okay.
for those that want to have a diversification, a diversified portfolio of gold miners, the big gold miners, like you say, because these are the Barricks and the Goldcorps and the Newmonts, the big ones, you know, the multi-billion-dollar ones. If you want to trade down to the GDXJs, which nothing wrong with those, but those are much smaller. They're going to be more nimble. They're also going to be more volatile.
People who are wondering, so much volatility, they wonder if they should or should not get in. What would you say to them?
I would say that I pulled the trigger and bought a lot of physical gold below 1,200 to the ounce. I'm happy today, obviously, because it's 80 points higher than that. I think that for folks that wanted some in their portfolio, but they were always afraid to chase it when it was 1,700, 1,800, pushing towards 1,900, at least on the futures contract, perhaps not on the spot, but futures got all the way up to there. I would say this is certainly an attractive level to me. I mean, I know a lot of smart guys like David Gerstenhaber over at Argonaut. We were talking to him just the other day, and I know he was famously short gold all the way down to right around the 1,300 level. Now, he's out of those shorts. I think the folks that were short were smart. They knew that there would be that whoosh, that flush at the end of the quarter because people didn't want it on their sheets.
Right.
But they had to be pretty nimble because June 28th was the low tick for gold. And then the miners took a few days into July, but then they just went off to the races too. So if you overstayed your shorts there, I think it was a bad decision on your part as far as buying either physical or the securitized versions of gold. I think these are much more attractive levels, and I don't know if we get back down to those 1,140 or whatever to the ounce for gold.
All right.